Right, traders, welcome back to the Liquid FX YouTube channel. Here we're going to be going over one of the most important concepts when it comes to Forex trading, indices trading, futures trading, options trading, commodities trading. It's the concept of understanding the higher time frame narrative and how do you produce a higher time frame narrative. And that's what we're going to be going over now. So as the title suggests, there's a 4-pillar approach that I teach all the students at Liquid FX, and it's something I want people to learn as well, right? So what is the 4-pillar approach? Well, it's quite simple. As the name suggests, there's 4 main aspects to the overall higher time frame bias creation. So what we need is we need market structure. Then from there, we need to analyze our dealing range. Once we've analyzed our dealing range, we understand we need to go to premium and discount arrays or PD arrays. And the last but not least, we want to understand inefficiencies or imbalances or fair value gaps, right? They all mean the same thing for the 4th point. These are the 4 pillars that we use to determine any particular market structure, market bias, sorry. So now if we go to the euro dollar on this is now the weekly time frame. I've already got the structure marked out, as you can see. So what we had over here is we had price giving us, if I just quickly draw out the structure, we had a structural low, structural high, structural low, structural high, and we have a structural low over here. So the break of structure is this swing low, and now we've seen an all-time low down here. So this is the overall structure. So the structure is bearish. So let's label this on top. So we've been through our market structure. So number 1, which is structure, we can label that as bearish. Excellent. Now, this is one thing. The next thing is the concept of a dealing range. And a lot of people don't quite understand the concept of a dealing range. The dealing range is quite easy to understand. It's the most recent structural high. So in this case, this is the most recent structural high. And it is the most recent structural low. So the structural high and the low both together form the dealing range. And it essentially tells us which particular structural range we're working in. Now, this is the dealing range over here for the euro dollar. Again, this is euro dollar, the weekly time frame. And we have a structural high up here. And we have a structural low down here. So this is what we use to project number 3, which is the Fibonacci tool. And we use that to project our PD arrays. So if our structure is bearish, by definition, our dealing range is consequently also bearish. And now from here, we use our premium and discount array, and we do that by projecting the Fibonacci tool from the swing high down to the swing low. So are we in premium or are we in discount right now? Well, we are in discount, right? We're below the 50% level. As you can see, we're slightly below. So we're in the discount. So now if we zoom into price in a bit more detail, right? Let's look at the most recent price action. So again, not the most decisive price action, but we can still trade this as it's the higher time frames that we're looking at. This is the weekly time frame. So again, what we have is we have 2 draws on liquidity. We have a bearish draw and we have a bullish draw down here, right? So from here, this is a weak structural high. Remember, the structural low is all the way down here, bottom left, right? This is the structural low. Now from here, as it stands, this structural high hasn't produced a new low at all, right? It's come down to here and stopped. And so we understand from a structural perspective, when we're in a downtrend, right, we see how higher lows break through and make lower lows. Then we see a retracement and we see another break of structure down here. So as it stands, these are all strong lows over here. This is a, strong high. This is a strong high. Yeah, and this is also a strong high, these two over here. Now from here, you need to understand this high over here. This high is the opposite of strong. It's weak because it hasn't actually produced a new high. And because it hasn't produced a new high, what we need to understand by that is that it's a weak structure. So this is a weak high over here. And weak highs become very important when we understand the DOL, which is a draw on liquidity. Very, very important to understand from a trading bias perspective, especially on the higher time frames. Once you've identified the weak high, or in this case, we have a weak high over here, it's the same principle down here. This is a weak low for the exact same principle. Right, we understand that the overall high up here is all the way up here, actually. So this is also a weak low. The reason it's a weak low is that because it hasn't contributed to any new highs in the market. It hasn't even broken the previous weak high either, right? So we understand we're dealing between 2 weak structures over here. So because we have 2 weak structures, we're kind of in this indecisive range. So if we head down to the daily time frame, the daily time frame paints, sorry, that's the 4-hour time frame. This is the daily time frame now. So the daily time frame paints a similar picture where what we have, again, let's use our 4 pillars to understand price, right? So we have a structural dealing range, this swing high down to this swing low, right? So this is our dealing range, which I've highlighted in the rectangle, right? So we see bullish structure to the left, turn bearish. Excellent. So once we've established our structure, our dealing range, our PD arrays, again, we project the Fibonacci tool from the swing high down to the swing low, just like this. And once we've done that, if we zoom into price in a bit more detail, we're right at the equilibrium. You know, we see last week, Friday, the last trading day, 12th of July, we see it touching the equilibrium exactly. And so because of that, my advice to you would be to stay, you know, avoid this pair or trading high R multiple trades, right? You want to be smart with your profit taking because we're at the equilibrium. That's essentially the tip I give to all the students, right? Because we're at the equilibrium, we could see price range as we have done over here. We see rangy price action over here, relatively rangy price action over here, relatively rangy price action over here. So we could range around this region. However, one thing to understand is that we've come from a discount. Notice how we've come from a discount, and from a discount, our job, of course, we understand, is to head to premium, right? So as it stands, price here could again sweep this. We have some trendline liquidity up here, so we could sweep this liquidity and head into this POI over here. And that's my overall narrative if price does remain above the equilibrium. So this POI is again marked at 1.105, 1.105. 1.1058, right? Well, let me type that in. 1.105. This is the overall narrative. So I am bullish on the euro dollar. Now let's take this same theory and apply it to the daily time frame for pound dollar, right? So again, it's the exact same principles where, again, let's start with our 4-pillar approach. The 4-pillar approach is basically all you need to understand price. So what we have over here is we have our structure, which is pillar rule number 1. Then we have our dealing range, which then becomes rule number 2. After we've identified our dealing range, again, what we have over here is we have our PD arrays. And last but not least, we have our inefficiencies or our fair value gaps. Now, the trick to understand is that do these in order. So don't just go PD arrays and dealing range and structure and fair value gaps. You want to go in order. So what's your structure? Are we bullish or bearish? Well, we had a structural high, we had a structural low, we had a structural high, and now we've had a structural break over here to the downside. What does this tell us? Well, this tells us that, yes, we have a bearish dealing range to deal with as well. Bearish structure gives rise to a bearish dealing range. So we've done point number 1, point number 2. Now let's go on to point number 3. We project the Fibonacci to from the swing high down to the swing low, right? These are my Fibonacci settings, you know, nice and simple. We only need really 2 numbers, really, to be honest. We have a structural high and we have a structural low. Anything above the 50% level is a premium. So now what have we seen, right? Now understand how price has effectively broken structure. We've entered a premium. Now we've entered a discount. We've come out of a discount. And we understand from basic theory, IPTA theory, price looks to target areas of discount up to areas of premium. Now, why have I got this POI marked out over here? Well, this POI is a POI for 3 reasons, essentially, right? There's 3 reasons that this is a POI. The first reason is that it's priced deeply in the premium, right? So it's premium priced, and we know price likes to target from discounts to premiums and vice versa, premiums back down to discounts. That's the first reason. The second reason is that it leaves an inefficiency marked out in the blue box over there. There's a clear imbalance or an inefficiency. And the third reason is that this POI or this region in price led to a structural break or a break of structure. The break of structure being over here, bottom left. And so once we've established that, from here now, my overall bias for GBPUSD using the 4-pillar approach is essentially bullish because I expect price to get up to this POI over here. Now, this POI is marked at, this is 1.3057, 1.3057. So this is the overall narrative we have on the pound, right? Pound dollar, to be precise. Cable is bullish pricing up to this overall POI. And now if we head down to the 4-hour time frame, now the 4-hour time frame again, we've seen a shift of market structure, right? So we've seen how price has gone from bearish to bullish, right? So what we've seen is we've seen the previous structural high being violated. So we've seen a shift of market structure over here. And now from here, the narrative does remain the same. I do expect price to get up to the daily time frame. The only thing you need to be aware of now is that we may see price give us a slight retracement before heading higher. So we could anticipate somewhat of a lower pricing before price gets to that daily POI. But ultimately, I am bullish on the pound dollar. Now for everyone's favorite, which is essentially the gold time frame, XAUUSD, right? So this is a market which is in high demand at the moment. A lot of people seem to like trading gold. So I can again provide an analysis on that using again the 4 pillars, right? So what was the first thing we looked at 4-pillar wise, right? The first thing we looked at is our market structure. The second thing we want to look at is our dealing range. This is boring, but I'm going to have to keep repeating it over and over again because once you've understood this, your trading will become a lot more clearer, right? PD arrays is the third thing, and the last thing, of course, is inefficiencies or fair value gaps, right? This is the order in which we analyze the charts. Now, we've had a structural break to the upside. So we had an all-time high, previous all-time high. We had a retracement, and that all-time high was broken. So this is the current all-time high. And since then, we've retraced into a discount. We've left some external range liquidity as prices now rallied up to a premium, right? Now, as it stands, this is a weak structural low. So yes, indeed, if all the other bearish POIs fail, we could just expect another all-time high. I am aware of that. We've come from a discount into a premium. This is a weak structural high as it hasn't broken the previous low. This is important to understand. Now, if we zoom into price action a bit more clearly, we had a bearish fair value gap over here. This is again a bearish fair value gap. If we head over to the most recent price action, we are now above the 50% level. Now, from here, we need to use the 15-minute time frame to give us a clearer perspective on things. The 15-minute time frame is bullish, right? So we understand we've broken structure again. We've broken the previous high over here. We've had a shifter break of structure over here, a minor retracement, and a shifter break of structure again. Now, going into the week ahead, how am I looking at the price? How am I looking at price action? Well, I personally am looking to sell in this premium down to a discount before continuing higher, right? So I am looking for price to come into this discount over here. I want price to come into this discount. What makes this discount particularly attractive to me is the fact that we have an inefficiency over here. We have a fair value gap that does need filling. We also have an Asian range low over here, ARL. We have an Asian range low, which also needs filling, right? So there's reason for lower pricing. And we're in a premium anyway. So you don't want to be buying in a premium. You want to be buying in a discount. And the discount here is attractive to me simply because we have a massive inefficiency to fill, as well as some Asian liquidity over here. Also some Asian liquidity over here. So this is my overall narrative for gold. I expect intraday self, again, down to this level. And then once we get to that level from here, I'll be looking for buys from the discount up towards the premium again. So this is a quick overview as to how we trade using the 4 pillars, right? You want to be using, let's quickly go over them one more time to end the video. What you want to be looking for is you want to be looking for your market structure. Are we bullish or bearish? Where are the highs? Where are the lows? Which lows are being broken? Which highs are being protected? Or vice versa. You then want to understand your dealing range, right? Your dealing range, the most recent swing low and the most recent swing high. In this case, in gold, we have the most recent swing low and we have the most recent swing high. After the dealing range, the next thing you want to be, sorry about that. After that, after your dealing range has been established, the next thing you want to look for is your PD arrays or your PD arrays, your premium and discount arrays. And last, you want to be looking for your inefficiencies or fair value gaps. So every single chart you look at must follow the same principles in the same order that I've got it on your screen.